So coming in at number 1 on the list here is probably the most popular buy and hold investment out there, and this is the Vanguard 500 Index Fund ETF trading under the symbol VOO. So this is basically a basket of the 500 largest publicly traded US companies, giving you built-in diversification if you choose to buy into this ETF. So just to cover some quick information on them here, this fund has an astounding $268 billion in assets under management, and they currently have 511 different individual holdings. Now, one thing you're going to want to pay attention to when you're looking at an ETF is that expense ratio. Now, Vanguard has some of the lowest expenses in the industry, so coming in at an expense ratio of 0.03% is very low. You also want to check out the tracking error, which is going to show you how closely the fund tracks an underlying index. This is coming in at a 0.01, so it's following it very closely. This benchmark index is, of course, the S&P 500, or the 500 largest publicly traded companies in the US. Now, investing in VOO gives you a little piece of all of these different companies. For example, the top 10 out of those 511 holdings, which makes up almost 30% of the fund. So basically, if you buy VOO, about 30% of your money goes into these 10 companies right here. This includes names like Tesla, Apple, Berkshire Hathaway, Facebook, Alphabet, aka Google, Nvidia, Microsoft, Amazon, and JP Morgan. So this particular investment is best for long-term investors looking for passive gains that will match the market. And honestly, guys, you could park your money in VOO for the next 50 years and most likely not run into any trouble, because you're basically betting on the US economy as a whole in terms of the 500 largest publicly traded companies. And here we have the 5-year performance of VOO. Obviously, we had a sell-off there after 2020 during the pandemic, but ever since then, it's been a pretty solid uptrend, and hopefully we will see things continue thereafter. But even if you do own any of these stocks, if you're focused on a super long-term investment, you have to know that there is going to be boom and bust cycles in the market, and be prepared to either hold your investments during those downturns or even potentially buy more at a discount. So coming in at number 2 on my list is a stock that I owned previously, and this is Coca-Cola, trading under the symbol KO. So this company was founded back in 1892. They have a market cap of $245 billion. They are a dividend aristocrat, which means they have been growing and paying that quarterly dividend every single year for over 25 years, which is very impressive. They have a 59-year growth streak in terms of how many years they've been growing that dividend consecutively, and they are currently paying an attractive yield of 2.96%. Now, Coca-Cola is good for long-term investors looking for strong dividends and steady appreciation. You're not going to see any crazy growth out of Coca-Cola, but it is going to be a very steady and consistent investment. Coming in at number 3 on the list here is Johnson & Johnson, trading under the symbol JNJ. This is another very, very old company founded back in 1886 with a current market cap of $429 billion. This is, in fact, another dividend aristocrat. They have also been increasing their quarterly dividends every single year for 59 years, and the dividend yield here is sitting at 2.52%. Now, Johnson & Johnson is a solid pick for those looking for strong dividends and low volatility. Also, I believe Johnson & Johnson is one of only 2 companies with the highest possible credit score rating from Moody's or Standard & Poor's, and I believe the only other company on that list is Microsoft. So they are looked at as one of the best stewards of their debts. Definitely something to consider as a Johnson & Johnson investor. Number 4 on the list is another company that I owned at one point. I also used to own some Johnson & Johnson, and I probably will own a lot of these in the future as well. But 3M is the Minnesota Mining and Manufacturing Company, something along those lines. Very, very old company. Founded back in 1902 with a market cap of $104 billion. This is another dividend aristocrat, which has been growing their dividend every single year for 60 years now, and they have a dividend yield sitting at 3.24%. Now, 3M is basically considered to be a conglomerate, which is a bunch of small companies or brands under one name. You know, they make things like Scotch tape, they make a lot of medical supplies, they make automotive chemicals, all kinds of different stuff and products. So they are very well diversified in the consumer products division and also B2B and sort of all over the place. Now, some of the industries that they serve are cyclical in nature, so you can see some ups and downs with that share price. And over the last 5 years, it hasn't really done too much, but they do have an attractive dividend yield above 3%. Number 5 on the list is another company that I like as well that I've also owned in the past, and that is Procter & Gamble, trading under the symbol PG. Now, this right here is the oldest company that we've talked about so far, founded back in 1837. Pretty incredible, I must say. And they have a current market cap sitting at $355 billion. They're also a dividend aristocrat, and they've been increasing that quarterly dividend every single year for 50 years. That's longer than probably most of us watching this video have even been alive. Currently, the dividend yield is sitting at 2.32%, and Procter & Gamble is a solid choice for long-term investors looking for strong dividends and also looking to add consumer product goods staples to their portfolio. The other thing I like about Procter & Gamble is they are able to very easily increase their prices. I know they did come out and say they are expecting to increase prices across a lot of different categories due to inflation, but they have this massive portfolio of brands, and they're basically, you know, a lot of personal care and hygiene products, things like that, that many of us are using every single day. I would encourage you to basically look at the back of a lot of these different cleaners or shampoos that you're using, and you'd be surprised just how many of them are a Procter & Gamble product. So coming in at number 6 here, guys, is more of an asset appreciation approach rather than a dividend approach, and that is the company Apple, trading under the symbol AAPL. Again, this is another company I've owned many, many times in the past, and I probably will buy shares again in the future. So Apple was founded in 1976, and they currently have a market capitalization of $2.43 trillion. Now, despite being a high growth investment, they do also pay a nominal dividend here, which has currently coming out to be a yield of 0.57%. And they have been increasing that dividend every single year for the last 7 years. So by no means is this considered to be really an income investment. It's really still considered to be a growth play, but having that dividend is also a unique offering here. That way you can get paid in 2 different ways while investing heavily in technology. So this investment is good for long-term investors, especially growth investors who are more focused on asset appreciation or increasing in share price, not so much earning dividends for cash flow. But they do pay a dividend nonetheless, so it sort of does, in a sense, give you the best of both worlds. Coming in at number 7 here is another company that I think we are all familiar with, and it's another company that is really a solid choice for a lifelong investment, in my opinion, and that is none other than Google. This company here, pretty wild. Founded in 1998, they're now one of the world's most valuable companies, sitting at a market cap of $1.96 trillion. Now, unlike Apple, Google does not pay any dividends. They're solely focused on growing the company, growing revenue, and increasing, the market valuation, and thus the share prices of Google for both their Class A and their Class C shares. Now, that is one nuance here with Google, is that if you are investing in them, they do have GOOG versus GOOGL. They trade at different prices. One of those shares has voting rights, the other does not. So that's something that you do want to consider if you are investing in shares of Google. Obviously, there's not really much that has to be said about why Google is considered to be a good lifelong investment. They've become so intertwined with our daily lives, and so many of us are using their services every single day. My entire business revolves around Google in terms of my YouTube channel or the different blogs that I operate that are really, capitalizing on Google search traffic. So Google, honestly, a solid play for the long term for betting on the future of this digital economy. So Google is best for long-term investors looking to gain access to tech and innovation. Obviously, they're only offering, you to basically earn money through asset appreciation, not currently paying a dividend at this point in time. And then lastly on the list here, we have Walmart trading under the symbol WMT. This is another company that I have owned in the past. Walmart was founded in 1962, and they now have a market cap of $413 billion. And Walmart is another dividend aristocrat where they have been increasing that quarterly dividend every single year for the last 48 years. Now, Walmart is an interesting stock here because it's almost an even mix of potential to earn money from asset appreciation or that share price going up, or to earn money from that dividend. So right now, the dividend yield is sitting at 1.48%, which is obviously not too high, but it is better than something like Apple, which was paying 0.5% as a dividend yield. So it's enough to actually be meaningful, especially if you're going to be reinvesting. So Walmart really gives you the best of both worlds here in terms of being able to make money from quarterly dividends as well as the natural appreciation of that share price. Also, I just wanted to point out here, if you looked at the share price here in the chart for Walmart, you would probably have not even known that there was a global pandemic in 2020. I don't even think they broke this trend line here, which is really insane. So this stock's been on a tear for years here, guys, from $60 a share up to $148. Many of us aren't the biggest fan of Walmart overall. I know I'm certainly not the biggest fan of them in terms of, a lot of their employees are on government subsidies, but nonetheless, it is a really solid investment here in a place that a lot of people shop. Not to mention, they also tend to do really well during a recession because when people have to be more careful with how much money they are spending, they're going to have to shop at discount stores such as Walmart. Now, the last thing I want to cover is where to buy stocks if you're looking to invest for the long term. And my recommendation is, of course, going to be M1 Finance, which is the main brokerage that I use myself. Through their investing side, they offer no commission trading, fractional shares, dividend reinvestment, automated rebalancing, and so much more with a minimum investment of just $100 or $500 for retirement accounts. And also they do have M1 Borrow, which is a flexible portfolio line of credit. And then in addition, they do have the M1 Spend debit and credit cards, which allow you to earn cash back in the process. I mostly use them for the investing side of things and the borrow, but they really are a solid choice for a long-term investment portfolio. They're also doing a promotion until the end of the year here, guys. If you're looking to get some extra bang for your buck, all you have to do is deposit the amount of money here on the right or transfer in an equal value brokerage account, and you can get a bonus of up to $500. So if you guys want to check that out, there's going to be an affiliate link for M1 Finance down in the description below. And I also have a completely free 30-minute step-by-step training that's going to walk you through how to get started and how to build a portfolio with M1 Finance. So that's going to be linked up down below, guys. I hope you enjoyed the video. If you did, make sure you drop a like and subscribe. And as always, I hope to see you in the next video.